$44 billion just left three major U.S. banks. Are more banks going to fail? And is the U.S. banking system beyond repair? Check this out.
Well, unless the Fed is willing to, walk back their current policy and give the banks some more breathing room, I don't think we get out. I think you'll see more banks fail. And the reason, Andrew, is that you have a couple of things going on at the same time. On the one hand, you have big losses sitting on the books of these banks. If the 10-year Treasury widens out to 4%, it looks worse. If it tightens to 3%, it looks better. Very easy, okay? But the cash flow problem inside these banks is not going to go away unless the Fed does something.
My friends and I have been talking. Some of them already withdrew all their cash from the bank accounts except for what they need to pay their bills for the month. Others also opened up more bank accounts and split the funds among them. Multiple stock brokerage accounts too. They say that banks are actually riskier than brokers because brokers, by law, must keep your funds separate from the company's funds. Interesting. In the last 3 months, $44.354 billion in deposits left the likes of three major banking giants: Bank of America, Morgan Stanley, and BNY Mellon, all in one quarter. According to Bank of America's most recent quarterly earnings press release, the lender's average deposits fell from $1.0063 trillion on June 30th to $980.1 billion by September 30th, a reduction of about $26.2 billion in only 3 months. Meanwhile, deposits at BNY Mellon dropped by $15.101 billion over the same time period, from $277.209 billion to $262.108 billion. And Morgan Stanley depositors pulled out $3.0534 billion from $348.511 billion at the end of Q2 to $345 billion at the end of Q3. And B of A, Bank of America, BNY Mellon, and Morgan Stanley are not the only financial giants to see huge declines in deposits. JP Morgan Chase, Wells Fargo, Citi collectively recorded $84.5 billion in deposit outflows from Q2 to Q3 of this year. That's why they've been sort of beefing up their interest rates. Now, apparently, JP Morgan, Wells Fargo, and Citigroup have all been shelling out billions of dollars to keep customers from moving their funds. The Wall Street Journal reports JP Morgan paid out $21.83 billion in interest expenses in Q3, up by 170% from the same quarter last year. Wells Fargo forked out $8.99 billion to customers in the same quarter, an increase of 275% on a year-over-year basis. Citigroup's interest expense accounted for $21.01 billion last quarter, a jump of about $185 billion from Q3 of 2022. And based on anecdotal reports from you guys, some banks across the US are only dispensing small amounts of cash from their ATMs instead of the daily limit. So there could definitely be something there. Don't forget to like this video and subscribe for more eye-opening updates on the financial world. Stay informed and stay secure, guys. Now let's talk about why the US banking system could be beyond repair. So first, there's the truth about fractional reserve banking here in the United States. The Federal Reserve Board reduced banking reserve requirements to 0 in March of 2020. Since that time, banks in the United States have not been required to actually hold any depositor money in the bank, making a flawed system, fractional reserve banking, even worse. Let me repeat that for you guys. Right now, as we speak, U.S. banks aren't technically required to hold any of your money in their reserves, making the whole system incredibly vulnerable to bank runs or people withdrawing their money all at the same time. See, with interest rates on the rise and a lot of commercial and personal loans defaulting on them, banks have a lot of unrealized losses on their balance sheets. Those unrealized losses are not necessarily a problem for a bank until customers decide to withdraw all their funds. This forces banks to sell bonds at a loss to have cash for customer withdrawals. You see where I'm going with this, right? And honestly, you don't have to look far for an example here. With Silvergate Bank, Silicon Valley Bank, and Signature Bank now shuttered, many in the US are wondering if other regional banks pose the same risks. And honestly, these zero reserve policies at the Federal Reserve only make further bank collapses more likely. You see, before the pandemic, banks had to hold 10% of deposits in cash. When depositors put $1,000 in the bank wasn't required to hold that $1,000. It holds $100 and loans out $900 to customers in search of a mortgage, a car, etc. Banks charge an interest rate on the loans, which is one way that a bank makes money. So, a bank account holder gets 0.2% interest, meanwhile, the bank provides loans at 4% and higher. Fractional reserve banking is what allows a bank to keep a portion of your money in the bank while lending out most of it to businesses and consumers. But if every single depositor comes for their $1,000, as we saw in the case of Silicon Valley Bank, the bank won't have enough cash on hand. If the bank is at risk of shutting down, then everybody's going to be rushing to get their $1,000 out. So that's point one. But actually, the Fed has sowed the seeds of the financial crisis in more ways than zero reserve banking. When the Fed funds rates increase, it affects car loans, housing, U.S. treasuries, and it makes small business loans more expensive. When the value of treasuries decreases, the yield of treasuries increases. Banks are affected because they have tons of treasuries on their balance sheets, as of the case of SVB. Banks that fail to hedge their risk go bust. And really, SVB's collapse is the price of the Federal Reserve's interest rate gambit. The Federal Reserve has been moving fast and breaking things. And outside of our financial freedom fam here on YouTube, not enough people noticed this until the collapse of Silicon Valley Bank. You might have heard this before. The Fed increases rates until something breaks. And we saw exactly that with SVB, Signature Valley Bank, and First Republic. It will be a long time before we completely understand exactly what happened with SVB's swift, stunning decline, but there's little doubt interest rate hikes had something to do with it. This would not have happened if the rates hadn't gone up so quickly and these portfolios hadn't gone underwater so much. Now, if we rewind the clock back to March 1st, Silicon Valley Bank was worth nearly $17 billion, and it had close to $200 billion in customer deposits. Now, these customers were mainly venture capitalist firms and the companies they were funding, which made this bank a big player in a very lucrative niche. But then, out of the blue, without much warning, Silicon Valley Bank announced that they were selling some of their treasury bonds at a loss, and it sent shockwaves through the venture capitalist firms that they were backing. They freaked out and advised the firms that they were backing to pull their money. And just like that, in a matter of days, $40 billion disappeared. The bank's stock took a nosedive and regulators had to step in. 2 days later, regulators swooped in on New York-based Signature Bank, which had over $100 billion in deposits. These were the two biggest bank failures since the 2008-2009 financial crisis and the second and third largest bank collapses in U.S. history. And what's really crazy is that it all happened so fast. Even in the 2008 crisis, there were signs that things were going south in the financial sector. But these bank runs, they were like a car crash that just came out of nowhere. The Federal Reserve, the very institution supposed to prevent this kind of chaos, was the one at the center of it all. The fallout from these two bank collapses sent shockwaves throughout financial markets. Shares of nearly a dozen regional banks went into a freefall because everyone was afraid that customers would bail and seek shelter with the big players like JP Morgan Chase and Bank of America. If we fast forward to today, the Fed is still pushing interest rate hikes, and everybody's been feeling it on their credit cards and their mortgages. Experts commented how the Fed has wanted to do stuff until something broke, and that something broke. And the next thing that breaks is that 2 million people are going to lose their jobs when the unemployment rate goes up. Not to mention, when rates go up, that pushes bond prices down. And any institutions that are on the wrong side of that can find themselves in a less sound financial condition than they might want to be. Which brings us to the real cause of what happened. A Fed that has been so focused on curbing inflation that it has essentially ignored the risks of its policy of raising rates more quickly than at any point in history. It has acted as if inflation is such a threat to financial stability that it lost sight of the fact that fighting inflation can, if pursued too aggressively, can itself be a threat to financial stability. The Fed takes its mandates of price stability and the guarding of the health of the financial system seriously. And it's definitely been crucial in times of crises, especially in 2008, 2009, and in March of 2020. But what doesn't get talked about enough is how the Fed can have a tendency to become detached from real-world implications of their decisions. We've been seeing this in the past year of aggressive interest rate hikes that have gone from a legitimate response to higher than expected inflation to what could be described as an out-of-control crusade to tame higher wages, a tight labor market, and robust consumer spending in the belief that sometimes you have to harm the economy in order to help it. Short-term pain for long-term gain and all that. You can see it in how the Fed seems to be ignoring the secondary effects of inflation fighting. Fed officials have spoken of a labor market that is too tight to an unhealthy level. Sure, a tight labor market might be a negative for inflation, given that it leads employers to pay higher wages in order to attract scarce workers, but in the real world, a tight market means that more people are employed and they're getting paid more. So hearing that the Fed wants to have less of that, it's perfectly understandable how that could make a substantial portion of actual humans who comprise the economy angry and that in turn will eventually undermine the credibility that the Fed needs to do its job. It's a tough situation. Inflation does appear to be falling, but it remains high. Beyond the ins and outs of what rate hikes mean for a handful of regional banks that may or may not be in a pickle, SVB's quick collapse nods to a bigger issue. The Fed's actions are going to have plenty of ripple effects across the economy, some of which could do a lot of damage and could catch people by surprise. Experts warn that this is just the beginning if they want to keep hiking at the rate that it's been hiking. The conventional economic wisdom is that combating inflation also means increasing interest rates to slow down the economy, which ultimately leads people to lose their jobs. The Fed's been quite open that it's looking for the unemployment rate to go up. Someone being laid off or fired may not make as many headlines as a bank collapse, but if you actually look at people's individual lives, it's still catastrophic. And if it happens on a broader scale for the economy, this could be really bad. Once layoffs start, it's hard to stop them, and the Fed just can't step in to boost workers like it has to boost the banks. I guess what I'm trying to say here and warning you guys about is how, for months, it's felt like something terrible might just be lurking around the corner in the economy, even if nobody can quite put their finger on it. And it's in the nature of financial events to unfold quickly. No one can tell you with any certainty, no one can tell anyone with any certainty that there's not another shoe to drop here. Maybe the best the Fed can do now is to pause and reassess its current inflation fighting path. Otherwise, it may succeed in taming inflation, but only at the cost of destroying an otherwise stable and sound economy. What do you guys think?